Hello, I'm Ken Carpenter, and this is Invest AI Savvy, where AI powers smart investing. Happy Monday, April 20, 2026. Today's signal of the day is American Airlines, ticket AAL, a mid cap equity trading around $12.78. Now, before we start, BuzzPulse is a social intelligence tool. Everything you hear today is data and commentary, not investment advice. I'm not your financial advisor, so please don't put any money anywhere unless you've done your own research. Okay. Now, uh, getting into it today, I want to spend a little bit more time than usual on the macro picture because what we're seeing in the market right now may not reflect what's actually happening in the world. And as investors, that gap between perception and reality is exactly where the risk lives and sometimes where opportunity can hide. So let me start with the setups and then we'll get into the bigger picture. Now, American Airlines is flashing a 10-layer convergence signal this morning, and it's not just social noise. Uh, BuzzPulse, the BuzzSurge Z-score is 7.0. Momentum is confirmed. Sentiment is bullish at plus 0.33. And here's the kicker: earnings drop in 3 days on April 23rd. Options activity is lighting up with institutions positioning, and the flow confirms the direction. This is a high conviction setup heading into a known catalyst. Why should you care right now? Because American is making headlines for competitive pricing on cross country routes, signaling strategic fare competition and revenue generation efforts right now before they report numbers. The options market sees it too. Institutions are building positions with unusual activity, and IV rank data shows traders are pricing in movement. American Airlines sits in both the Russell 2000 and the S&P 500, so it's got index visibility and liquidity. The convergence depth here is exceptional. 10 independent signals all pointing the same direction. This isn't a rumor play or a meme spike. This is a data driven setup with a hard catalyst 3 days out. Watch the stock closely between now and Wednesday morning. If social momentum holds and options flow stays, bullish could run into this print, and this could be a good one. So keep your eye on AAL. Now, next up is AMC. AMC, small cap activity, looking at trading at $1.86 with a greed score of 0.453, the highest alpha potential in today's supporting signals. A Z score of 5.1, momentum confirmed, sentiment bullish at plus 3 point at plus 0.31. Short interest sits at 15%, and unusual options activity shows institutions positioning. IV rank is 57%, so options are mid range, not cheap and not expensive. The social catalyst here is fascinating. The crowd is mocking failed predictions around AMC reaching $1 million per share, suggesting past bullish claims were unfounded. That's contrarian attention. When the crowd laughs at old predictions, it often means the narrative reset is complete and a new leg can form. AMC has been left dead multiple times, and every time short interest stays elevated and social attention resurges, it finds a way to move. This isn't a buy signal, it's a watch signal. If institutions keep positioning and that 15% short interest becomes a problem for anyone caught on the wrong side, this could get interesting fast. Now, the third signal of the day is Rumble, ticker symbol RUM, a mid cap equity at $6.32 with a greed score of 0.386, Z score 1.8, momentum confirmed, and sentiment is max bullish at plus 5 at plus 0.50. That sentiment reading is the cleanest in today's entire signal set. When we see social attention accelerating on a name with no negative cross currents, no short interest drama, no macro overhang, just pure positive flow, that's often where the early mover alpha lives. Rumble doesn't carry the options intelligence or the catalyst detail of the earlier signals, but it's on the radar because the social signal is clean and the conviction is there. Sometimes the best discoveries are the names that haven't been explained yet. If you see continued social acceleration over the next 12 to 24 hours, dig deeper, check the chart, check the news flows. This is the kind of setup that rewards traders who do the homework and their due diligence before the crowd catches on. Now, let's talk about the macro picture because this is where it gets interesting. The VIX is at 19.6 today, up 2.6% over 5 days. That's normal volatility, no, no fear signal. The S&P is grinding, the Nasdaq is holding, and on the surface everything looks fine. But I want to challenge that for a minute because I don't think this market is pricing in exactly what's happening in the world right now. Let's start with the Strait of Hormuz. For anyone who isn't tracking it closely, the Strait of Hormuz is a narrow waterway between Iran and Oman, and it's one of the single most important choke points in the global economy. Roughly 1 out of every 5 barrels of oil consumed on this planet passes through that strait. We're talking about 20 million barrels a day. Liquefied natural gas flows through there too. If Hormuz closes, even partially, and it looks like it is right now, the entire global energy market reprices in real time. Oil goes vertical, shipping rates explode, inflation expectations reset, and every airline, every trucking company, every manufacturer, every consumer feels it within weeks. We've seen tensions around Hormuz escalate recently, and yet, if you look at crude oil prices, if you look at energy volatility, if you look at the VIX this morning, the market is treating this as a low probability event. The pricing reflects complacency, not concern. This is what I would call an asymmetric rest. This is what I call an asymmetric risk. If nothing happens, the market is correctly priced. But if something does happen, even a shipping disruption, even a single tanker incident, even an escalation that falls short of full closure, the repricing would be violent and it would hit assets that today look perfectly healthy. Airlines, cruise lines, consumer discretionary names, anything that depends on cheap fuel or global supply chains. Now, contrast that with what's happening in South Asia. The Pakistan peace talks continue to progress, and that's a genuinely positive development for regional stability. We've seen a de escalation framework come together, diplomatic channels are open, and the rhetoric has cooled significantly from where it was a few weeks ago. That matters because South Asia holds roughly 1/4 of the world's population, and any sustained stability and any sustained instability there reduces all risks across emerging markets, shipping lanes, and commodity flows. So we have a split picture. On one side, a progressing peace process that the market is quietly benefiting from without really crediting it. On the other side, a Hormuz situation that the market is essentially ignoring. Both of those are risks, one to the upside, one to the downside, and neither is being fully priced. That's why I keep coming back to this idea that we're in what I call a precarious calm. The indices look fine, the VIX looks fine, sentiment looks fine, but the ingredients for a sharp move are all sitting on the table. You've got an energy choke point risk. You've got geopolitical variables resolving in both directions. You've got an earnings season that will test margin assumptions. And you've got a Federal Reserve that is still navigating a delicate inflation path. What does that mean for you and how you approach setups we just covered? It means position sizing matters more than it usually does. It means having a stop is not optional. It means that the catalyst in front of American Airlines, that April 23rd earnings print, is going to land in a market environment that could be calm or could be turbulent depending on what happens over the weekend between last Friday and the market opening this morning. And you don't have to you can't really control that. What you can control is how much you're willing to risk and where you're willing to be wrong. Now, here's the educational takeaway I want to leave you with today. When the markets look calm relative to the news flow, you have two choices as an investor. You can assume the market knows something that you don't, that the pros have already weighed these risks and found them manageable. Or you can assume the market is underreacting and position accordingly. History suggests the truth is usually somewhere in between, but the tails are fatter than people think. The discipline right now is not to abandon your setups. The signals we cover on this show are real. American Airlines has a convergence signature that's hard to ignore. AMC has a short interest dynamic that could move quickly. Rumble has the cleanest sentiment in today's entire scan. Those are genuine opportunities, but the backdrop requires you stay nimble, keep your risk defined, and respect the fact that the news cycle can overwhelm any individual setup on any given day. Bitcoin dominance is at flat at 57.5% today, which tells you capital isn't aggressively rotating between crypto majors and alts right now. Steady state. We'll keep watching it. And in a week where traditional markets feel artificially calm, watching how crypto behave is often the early test for where risk appetite is actually sitting. So to recap, American Airlines is the high conviction catalyst play into Wednesday's earnings. AMC is the contrarian short squeeze watch. Rumble is the clean sentiment early mover candidate. These setups, three different profiles, all surfaced by the same convergence engine. And the macro lens today is this: don't let a quiet VIX convince you that the world is quiet. It isn't. Hormuz is unresolved. Pakistan is progressing but fragile. And the market, for the moment, is looking through all of it. That might be the right call, or it might be an opportunity setting up in real time for those who are paying attention. Remember, BuzzPulse tells you what the market is talking about and whether that attention is unusual. It does not tell you what to buy or what to sell. That's your call. But I'm Ken Carpenter. This is Invest AI Savvy, and that's the way it is.